Let me ask you a question. Ever thought about options trading? Maybe wondered what it was, thought it was too complicated or there was too much risk? Well, that was me a year ago. Hey guys, welcome back to Old Guy Talks Money. Today I'm going to walk you through the process of making a live options trade. The plan goes as I hope at the end of the week we'll come back, tag on to this video, show you how we turned out. Okay, so let's jump right in. So let me give you some background. I own 800 shares of Truist in my taxable brokerage account. I own 800 shares in my Roth IRA. I had been selling secured cash puts, went into the stock at 43.50, so that's my current basis. I'm going to use that as the bottom that I'm willing to trade against because I don't want to potentially take a loss on my basis. Okay, I will show you something so you know. Let's go to my accounts. All right, right there, there's Truist. Now, if you come over here and say, well, it says it's a price paid of 43.38 per share, and you just said you went in at 43.50, why is it different? Well, the way this works is once you go into the stock, that price, your basis gets adjusted downward. It lowers that basis down. So essentially, you're deferring the gain on that till you actually sell those shares. And it's kind of one of those things that until you sell them, it just sits there. So it could be short term if you sold it within a year, or it can convert to a long term gain. Sold it after a year. Okay. So this is how I normally start. I'm going to go up here. I'm going to click Truist. All right. Now Truist is currently selling at 42.27. It's up 43 cents a share. Okay. Click on the options tab. All right. And then right here, I'm going to click the Greeks. So the reason I'm going to click the Greeks is I'll show you, this is the number that I'm using to help determine whether I want to make this trade. This delta column right here indicates of one of many things, the chance of profitability. So you're looking right here about a 20. That says there's about a 1 in 5 chance that the contract will get exercised by the buyer. Okay, so let's think about how this works. I'm selling covered calls. I own the shares. Okay. I'm entering into a contract. I'm selling the calls. There's a buyer. He has the right, not the obligation, to buy my shares on the expiration date. Okay. For that, I collect the premium. Okay. One or two things are going to happen for him at the end. He'll either go, okay, he agreed to sell these to me at 43.50. Market's at 45. That's a pretty good deal. I'm going to exercise the contract and he will buy my shares. Okay. If it's below that, he can obviously get it cheaper in the market. He's going to let that contract expire. On my end, I am obligated to sell at the strike price. Okay. One or two things will happen. He will either exercise them, the shares will get called away. I'll get the money for the shares plus any gain, and I get to still collect the premium. Okay. So that's the gist of it. So when I do this, I want to trade somewhere around a 20 delta. That's this number right here. I also want to stay in this range right here at 43.50. Okay. I do not want to go below this because if I do, I run the risk of losing money on it. Preferably, I'd like to be up here at about a 44 or a 44.50. That's where I would make not only premium but gain. See the deltas, it's really low. And you also see the premiums, they're just not attractive. I did this earlier, just kind of playing with the math. I can tell you that at a 20, right here, at a 20 cents per share, I'm going to make roughly a 23% return on my money. So that's where I'm going to try to go. Okay. Let me show you how to do this. We're at 43.50. I'm going to hit trade. I'm going to pull up the trade screen. All right. We are selling a call. We want to sell to open. If I was buying the contract on the other side, I would obviously be buying and paying a premium. I am going to be selling. All right. I have 8 contracts. Each contract is 100 shares. Okay. So I put in 8. It's going to expire this Friday on the 20th. My strike price is 43.50. Okay. Type call. Now you can see this is the range right here, right now, the bid and ask. I want 20. So I'm going to go right here and I'm going to put in 0.2. Now, why did I put a limit? So a limit will set a floor. Okay. Means that this order will not execute unless I get this or more. If I just went in with a market, it could close right here at 13, and I don't want that. Okay. So I don't know right now if this trade will actually, fulfill, but we're going to go ahead and try it. All right. So let's click preview. I can tell you guys from doing this that you always want to make sure you look at this, because you don't know how many times I have gone in and put a buy to open instead of sell to open. Again, selling covered calls, I own the shares. Okay. Sell eight contracts, so that's 800 shares of Truist at 43.50. Okay. And then my price at 20, it says right here, net of my commission, I should make $155.88. And an annualized return, that's about roughly 23% plus or minus a little. All right, so I click place, and that's all you have to do. Now, let's do it real quick. I'm going to do my Roth. I always try to do them together. Click Roth, click here, switch it to call, want to switch it to sell to open. That's the thing you always got to make sure of, because I tell you, I do that all the time. Forgive me moving around, but I can't see my keyboard that well. All right. See what happened? Want to make sure we change this to 43.50. Okay. It just defaulted to 42.50. All right. Call. I'm going to select limit again. I'm going to put in the 0.2. Preview the order. Double check it. Sell to open. 8. Truist. Make sure I'm in the right account, which I am. Price at 20. It's good for the day. The limit price. Place that order. All right, that's it. Now, in an earlier video, and I've been making, tracking my progress throughout the year, doing monthly videos of how I've done. Let's just recap the strategy I'm using just real quickly. What I'm doing is something called the wheel strategy. You start with cash. You sell secured cash puts. Essentially, you're agreeing to buy the shares at a certain price. You get a premium for that. You roll that wheel until you go into the shares. Once you get the shares, you turn around and sell covered calls. This is the side you saw today. I own the shares. I'm selling covered calls. Based on the price that I put in at 43.50, I will not make gain on it. But again, I'm making an annualized return of 23% and some change. I'm happy with it. I still own the shares. If I get taken out, no harm, no foul. I'll collect all the money, and I'll turn around and go back in by selling secured cash puts. That's why they call it the wheel strategy. So that's how you place the trade. So this is what we're going to do. I've got a flight this afternoon, so I don't know if I'll be able to add to this video yet. What we'll do is this. I'll either, these trades will either execute and we'll go in, and then we'll come back at the end of the week, or I'll come back at the end of the week and say, you know what, the trades didn't execute, but at least you saw how to do it, and then we'll kind of go from there. It may be that if they don't execute today and I get an opportunity tomorrow while I'm traveling, I may try to get in. We'll just see. But I wanted to show you how to do it before I got gone. And then hopefully we'll follow up at the end of the week and see how it worked. So guys, I hope you enjoyed the content. Hope you found it a little educational, a little informational, a little entertaining. If you did, please hit the like and subscribe. It will help me grow the channel. And I will see y'all in the future. And we're back, guys. Let's do a real brief recap. Last we talked on Monday, I placed 2 trades, 8 contracts or 800 shares of Truist TFC in my Roth IRA, 8 contracts or 800 shares on my brokerage account, also TFC. Had a strike price of 43.50, had an expiration date of Friday, which was the 20th, and then I set a limit of 20 cents per share. And you've heard me say this before, I always use a limit because it sets a floor that the trade will not execute if you can't get that price. Now, it can go above that price, but it won't go below that. So I placed that trade Monday, left for the airport, arrived in Vancouver about 9 o'clock, 9:30 their time. Finally got to the hotel, checked my trades. They did not execute. Okay, I'll show you what the price movement looked like. But we kind of started early in the morning with some upward momentum and place the trades, and then they didn't execute. But because I was on the West Coast, when I got up in the morning, the market had just opened, so I placed the exact same trade on Tuesday. Now let's look what the price did during the week. All right, so this is what the price looked like. Here's Monday. and I placed that trade somewhere right around here. Okay. You can see that went down, kind of bounced, went down. By the time we got to the end of Monday, that trade had not executed. So I got up on Tuesday morning, placed the exact same trade, 43.50 strike, Friday expiration, 20 cents a share, set my limit, and went to my meetings. You can see that we kind of came down and then we started getting this upward movement. And I can tell you that the closer you get to your strike price, the higher the premiums get, and also the more likely you are for that trade to execute. So it did execute for me on Tuesday. Went down, bounced down, and you see we had good run up, and this was probably Thursday. This was after the Fed announced rate cuts. Honestly thought I had a chance to get taken out. You know, my strike price is 43.50. You can see right here, it went up all the way to 43.25. That was the high. As we moved through Friday, came down, bounce, and then we closed at 42.34. Now, when I placed this trade, there was two outcomes. One outcome was that the stock price went in higher than my strike price, so somewhere above 43.50. The buyer of that contract would exercise his right and buy my shares. Why does he do that? Well, if the market's at, let's say, $44, he can get my shares at 43.50. He's going to do that because they're cheaper. Because it closed under the strike, that contract expired. I still own those shares. And on Monday, if the market's working for me, I'll place another trade to end next Friday. So that's how the week ended up. You saw it start to finish. Place the trade. You didn't get to see the second trade I placed, but it was the exact same as the first one. All in all, I'm satisfied with how it turned out. Well, what did I make? All right, guys, so here's what it looked like. 800 shares, 800 shares. Here's my strike price. Here's my basis. Here's the premium. This was my gross proceeds less the commission. It's a little over, I rounded here, but it's a little over 50 cents per hundred. It's about 5 basis points per share. Okay. So this is what I netted. Here was my closing price. Here's my annualized return. So all in all, a 23% return for the week. Very satisfied. So that's pretty much it. Stem to stern. I'll do this again Monday, and at the end of the month, I'll come back and show you how the whole month looks. So if you're finding the content a little informational, a little educational, maybe a little entertaining, please hit that like and subscribe. It will help me grow the channel, and I will see y'all in the future.